Hi everyone, and welcome back to my channel. I'm Dean, and I'm back for another video where we break down what's the latest in today's commercial and industrial real estate market. Think you know what's happening in Toronto's industrial real estate market? Think again. While everyone's been talking about downturns and crashes, something completely different has been quietly unfolding in the Greater Toronto area. The latest fourth quarter data just dropped, and it's about to shatter everything you thought you knew about this market. What if I told you that what looks like a market collapse is actually the best thing that could have happened? Stay with me, because by the end of this video, you'll understand why smart investors are getting excited about opportunities that haven't existed since before the pandemic hit. Let me paint you a picture of what's really going on. Throughout most of 2025, the narrative has been doom and gloom. Economic uncertainty, market adjustments, everyone bracing for the worst. But here's where it gets interesting. The fourth quarter data from Toronto's central and north industrial markets tells a completely different story. We're not witnessing a crash. We're watching something much more valuable unfold. This is what market experts are calling a rationalization. After years of inflated post-pandemic pricing that frankly made no sense, the market has finally found its footing. Think of it like a pressure cooker that's been slowly releasing steam instead of exploding. The numbers tell the whole story. In the central GTA, average asking rents dropped from $16.08 per square foot to $15.78. That's not a collapse, that's a healthy correction. But here's why this matters for you. This rationalization has created the most balanced environment between landlords and tenants we've seen in years. For investors with capital sitting on the sidelines, opportunities are emerging that simply didn't exist during the frenzied post-pandemic period. The market is finally making sense again. Now, here's where things get really interesting. The data reveals something that's reshaping the entire industrial landscape. There's a massive divide happening right now between different types of properties. And understanding this could be the difference between making money and losing it in 2026. Quality has become king. I'm talking about a clear separation that's happening across the entire GTA between modern, efficient facilities and older properties with functional limitations. This is not just a trend in one area. It's a region-wide phenomenon that's creating winners and losers. In the North GTA, premium facilities with ceiling heights of 32 feet or more are commanding top-tier pricing between $17.50 and $18.95 per square foot. These properties feature everything today's businesses need: high clear heights, efficient truck access, modern infrastructure built for e-commerce operations. Their rental rates have remained remarkably stable throughout this entire market adjustment. Meanwhile, the older properties are facing a harsh reality: lower ceiling heights, outdated infrastructure, poor truck access. These functional constraints have led to steep rent reductions and continued downward pressure. The market has spoken clearly. Businesses are willing to pay premium prices for modern functionality, but they're demanding significant discounts for anything that doesn't meet their operational needs. This quality divide is creating two completely different investment landscapes. If you're looking at newer, well-designed properties, you're entering a stable market with predictable returns. If you're considering older facilities, you're playing in a much more volatile space where significant value engineering might be required to compete. But the story gets even more fascinating when we look at how different parts of the GTA are performing. While many people lump Toronto's industrial markets together, the fourth quarter data reveals two distinct markets with completely different value propositions. The North GTA has emerged as the premium market. With average asking rents of $17.19 per square foot and sale prices averaging $514.6 per square foot, it's commanding the highest values across the region. The appeal is straightforward: newer product, higher ceiling heights, and superior shipping access. This is where businesses go when they need state-of-the-art functionality and are willing to pay for it. The central GTA offers a different value equation entirely. Lower average rents at $15.78 per square foot and sale prices at $372.54 per square foot. But don't mistake lower prices for lower value. The central market's competitive advantages are all about strategic positioning: closer proximity to labor and population density, direct access to major highways and transit networks, and significantly lower development charges compared to surrounding regions. These two markets aren't competing with each other. They're serving different business needs. Understanding which market aligns with your investment strategy or business requirements could be crucial for success in 2026. Now, here's the data point that changes everything about how we should view this market. The fourth quarter saw something that nobody was expecting. After months of negative absorption throughout 2025, the market suddenly recorded over 2.4 million square feet of positive net absorption across both the central and north markets combined. Let that sink in for a moment. Businesses are not just staying put, they're actively expanding and taking on new space. This represents a massive return of confidence that contradicts every downturn narrative you've been hearing. The North GTA led this turnaround with an enormous 2.19 million square feet of positive absorption. The central market added another 262,000 square feet. Together, these figures paint a picture of a market that's not just stabilizing, it's actively gaining momentum. This absorption data is perhaps the most important indicator we have of real market health. While rent prices and sale values can be influenced by numerous factors, absorption tells us what businesses are actually doing. And what they're doing is expanding, investing, and betting on the future of Toronto's industrial market. So, what does all this mean as we head into 2026? The story of Toronto's industrial market isn't one of decline. It's a story of successful recalibration. The extreme volatility and irrational pricing of the post-pandemic era has given way to a more balanced and sustainable environment. This creates fresh opportunities for everyone involved. Investors can find risk-adjusted returns that haven't been available in years. Businesses can secure modern industrial space without paying inflated premiums. Developers can build projects based on rational market fundamentals rather than speculative demand. The question now isn't whether the market will recover, it's where the smartest money will find the best opportunities. With quality becoming the key differentiator and two distinct markets offering different value propositions, 2026 could be the year that separates the strategic players from everyone else. What we're witnessing isn't a market downturn, it's market evolution. And evolution always creates winners for those positioned to recognize and capitalize on change. If you found this insights helpful, make sure to like, subscribe, and share. And if you want market insights tailored to your specific real estate goals, feel free to reach out. Thanks for tuning in, and I'll see you in the next update.